You are listening to Lender Lounge with Kevin Kim, a podcast dedicated to helping those in the private lending industry grow, improve, and streamline their business. I'm Kevin Kim, partner at Gerasi LLP, the nation's largest private lending law firm. Join me as we chat with the best and brightest in private lending, who are eager to share their years of wisdom and best practices with lenders, borrowers, brokers, investors, and more. Subscribe to Lender Lounge on your favorite podcast platform and learn more about Gerasi and how we can work with you at gerasilawfirm.com. Check out the episode summary for other valuable resources. Hey everyone, welcome to another episode of Lender Lounge with yours truly, Kevin Kim. We are at the tail end of season 4, and I have another repeat guest, friend of the firm and someone I really enjoy talking to, my friend Beth O'Brien. Thank you for joining us today. Please tell our audience about your wonderful self, and let's get started with this episode.
Thanks, Kevin. I'm so happy to be back. As you may remember, I am one of the few people who's had a career that looks like it leads up to being the head of a private lender organization, and that I did it on purpose. I will tell you, I did not do it on purpose, but it did actually, my background does actually blend to kind of just the right spot. I was one thing I like to, I was a lawyer for a very short period of time. And then I went in-house at Goldman in the real estate principal area. And there I really spent most of my time working on commercial real estate and did that kind of almost around the world. When I came back through a series of different things, wound up at Citi doing residential mortgages. And so by the time I had evolved in the crisis to starting my first private lender, which was auctionfinance.com, I had been in a great position where I had done both commercial real estate and residential real estate and mortgages, and some securitization along the way as well in both areas. So it looked like it was kind of a nonlinear career, but once I wound up in private lending, the combination of the commercial, the residential, the securitization expertise, it made me able to produce the type of loans and the type of assets that the market could really digest, taking advantage of what was going on in the residential market, but through the commercial loan structure. And I think that's really been what has been driving me even in the past iterations and in the brand new company. Like, how do we take advantage of what is going on in the residential market, do it in a commercial structure, and then somehow be able to backlever the whole thing? Like, is it securitization? Is it other things? What's going on? Particularly because we're in this challenging rate environment. Some people look at me and they're like, are you crazy? What are you doing starting another, private lender in this market? And I would say it's actually kind of, I think, a really great time to lean in. There are things going on in the market that are particularly positive, even though obviously rates have moved in a historic way in the past couple of years. But we should be able to, especially without any legacy issues, really take advantage of leaning into this market.
We had you on the show last, and one of the big takeaways I had was you were one of the pioneers of the institutionalization of hard money into private lending. And right now we are at this really strange evolutionary stage. Yet, to your point, there are new businesses being stood up. There are new institutional businesses being stood up. And we've interviewed some of the new some of the CEOs that have come now in their third iteration, fourth iteration. Now you're in your new company, Encore Finance Capital. Love the name. Can you tell us more about Encore? Tell us more about the mission statement. What is it that Encore is going to be doing in private lending?
So we're looking at both bridge lending and perm lending and across the business purpose space. I would say one of the things that really drove me this time, other than making sure that the strategy of the loan product is something that addresses what the market needs, is also understanding how to find the right capital per loan. I think in the past, it's been easier to find kind of a one-stop shop for capital, or that when capital was really flowing, that it was flowing kind of equally into all the different nuanced asset classes. we're in a position now where each of the different products really has a best source of capital. And so one of the important things I think to do now to make sure that the clients are getting the access to the type of products they need is to knit together different buckets of capital for different types of product, which may seem a little harder, but I think anyone who's ever been creative and flexible in this market has always relied on more than one outlet. And I think it's just become more important now to make sure that you're looking for literally the best source of capital for each one. Because people are, the clients don't have as much room. There just isn't as much spread. You actually have to match the right source with the right outcome. And so I think combining the front end and the capital markets has become even more important than usual. It was never unimportant by any means, but there was just a little more room.
I tend to agree with that. And that's definitely been a trend as you've seen LifeCo jump in more. There's diversification at the institutional level. I want to spend time on that, but I want to get on the more retail front. For a lot of our listeners are originators. A lot of our listeners are folks that sell loans. Tell me more about Encore's, Main Street side of things when it comes to lending. Is it going to be a wholesale outfit? Is it going to be a retail outfit? Is it going to be all of the above? What is the mission when it comes to origination as it pertains to Encore?
So we are predominantly a direct originator, and that also includes brokers. It might include some white label, but I think the dominant DNA is really direct originations. So either direct to sponsors or direct to brokers who are deep in this market. Certainly, we have a lot of broker and direct business, but we are not at this time buying loans from the market. We are creating the loans.
Last time you were on the show, you really impressed me with this. I always use it these days, the burgers, fries, and shakes analogy. Now, are you bringing that same level of discipline and consistency to Encore with the different sources of capital, right?
No, you really need to, or you cannot be efficient, right? Like the important thing, particularly when you're starting from scratch again, is not only are you building the right product that the market needs, but can you build it at scale and profitably, right? Otherwise, like, why bother? It's not, you can't make it up in volume if you're not building the right product that people need. And in this space in particular, again, this is the combination of residential and commercial, but it has both the benefits and the negatives of both. So what I mean by that is you can do residential loans. They're really a commoditized product. And you can build out all the technology and you can run it through on almost on a conveyor belt type process, right? Now, commercial loan can be much more lucrative, but it is in general a bespoke product. So how do you marry this, the residential aspect with the bespoke aspect of a commercial loan, but do it in a way that's both scalable and profitable? And that's where you have to have technology, you have to have an approach, and that's where the burger, fries, and shakes come in. It's not like you're telling people they can never do it. It's not just a simple box that you're just turning into like you can with a consumer loan, and not that they're simple, but they're commoditized at this point.
They're all remarkably very similar, right? They're either, on the conventional side especially, it's all within one particular narrow subset. So you're saying that it's not necessarily the parameters of the loan themselves. The loans will be customized.
The loans are still going to be somewhat bespoke. They have to be to address the client's needs. But have we built a process, a due diligence process, an underwriting process, the technology even around ordering appraisals can be something that gives you this very efficient lift so that you're not, dropping and dragging and doing everything in email and Excel. Because otherwise you can't do, it's funny, people look at my loans and they're like, wow, Beth, your average loan size is nice and large if they're doing, single asset. Whereas a commercial originator looks at me and says, how do you do loans that are so small? Right. And so that's where I'm comfortable, is somewhere between where everybody else is comfortable.
And I just got back from a commercial real estate show, because we have that part of our practice group on the security side. And it's fascinating because you're seeing a ton of the guys that we did multi-industrial, retail and office. These guys that were in the major 4 food groups in commercial now coming to the table and say, we would rather have those, what they call small balance build to rent deals, where they're realizing, hey, there's a lot of room here, there's a lot of opportunity here. And so that actually raises another interesting question for you is, will Encore also be participating in construction lending? Because it seems to be a big trend in the market.
Yes, and in particular in the build-to-rent space. I think there's really a strong appetite for it. They're both at the construction lending piece and then the lease-up piece, it's only a different product because of what I said earlier, because it's a really different bucket of capital that's interested in both of them, right? Like a lease-up loan takes a different risk weighting at a life co than a construction loan. A construction loan is probably not suited for life co balance sheet. And so in this, it kind of bringing the two ideas together, if you're knitting together the right capital source for each product, you probably have two different capital sources, even though as the lender, you want to be the transitional lender, you want to be the life cycle lender for that particular client, regardless of where they are in the cycle. And that could be the construction loan, it could be their lease up time period, which interestingly, the banks have it. Like each of these loans has a slightly different friction point for certain types of capital in the market. And then at some point, you want the fully stabilized permanent loan. And could be an agency loan on some of the build to rent, but is not always agency eligible, or not always the best loan for that particular client for a variety of reasons. And as I'm sure people mentioned, sometimes the build to rent is single tax parcel, which makes the commercial group feel really comfortable. And sometimes it's individually parceled, which makes the more residential investor feel really comfortable. And again, somewhere in between, and is it amenitized, is it not amenitized? These are all different flavors of build to rent that can affect not just your product set, but again, your source of capital or your best source of capital.
I noticed what used to be pretty much SFR driven was now becoming a more diversified conversation. Like the products that a lot of brokers were at this event, and we're looking at all these different terms, because they're also looking for LPs. And I'm like, this is very interesting, because what used to be just, what looked like a smaller version of a master plan is now, townhome development, condos, SFR, small multi. A lot of this stuff is being brought over to build to rent, as opposed to, you saw a lot of that kind of bank style loan before. So it's great to be a private lender right now. What was the thing I was there? The sentiment was, it's great to be in resi and it's great to be in private lending right now if you're in real estate.
Well, look, there's a bunch of things driving it. And like you said, it's not all I think people's vision of built to rent is kind of the bungalow style community, maybe, which is just, it's everything now. It's anything that you think of in either residential or multifamily could be considered built to rent.
As long as someone's living in the property at the end of the day. Yeah.
But also, as you know, there's just a dearth of housing, of affordable housing in the U.S. right now. Like we don't have enough homes for the household formation numbers. And it's not like the scattered site, there's not enough home transactions off the MLS to provide it either. And so if you don't start creating homes, you don't start creating someplace for people to live. And not everyone wants to live in a city, in a large multifamily. Some people want to live where the jobs are and in these suburbs. And that's why I think the build to rent is seeing such a, this is a strong season for it.
I've done multiple interviews this season of, new iteration, new business for a seasoned veteran. And the question still remains, why? Right? Because it's been a tough year. Last year was pretty tough, and the year before that was pretty tough, and it's getting tougher and tougher. And the sentiment seems to be, you're looking at it the wrong way. Are you in the same camp? Like, why did you start up again? Considering you didn't have to come back, right? You didn't have to come back. Yeah, you obviously did not need to come back.
No, I didn't have to, but I was getting inquiry from from the clients, like, what are you doing? Like, when are you back? Like, what's going on? Because the truth is, the clients are doing things, and there's actually a need to have an impact on the space. The space has come light years from 10 years ago, but there's still, I think, a lot of room to go to make this its own asset class and to really finish the institutionalization.
Well, please expand, because I don't necessarily know. I don't see what more can we do? I mean, I feel like the space is like, this asset class has become the darling of institutional investors. It's the only finance class that seems to be doing very, very well, you know, in volume, right? There's still a lot of, the proof is in the pudding. You see a ton of conventional and non-QM guys jumping into the space. So there seems to be a lot of interest, but yet at the same time, no volume.
There's no volume there. It's interesting. The private lender volume at some shops is down a decent amount, but at others it's not. And what I think you are seeing is not really consolidation, because there hasn't been much M&A, but you're seeing market share being driven to some of the really strong players. And it's mostly due to what kind of capital they have behind them.
That's a good point, right? So consistency in capital sourcing, diversification, capital, but at the same time, volumes are down even in our sector, at least low double digits, right? In the teens, they're down.
They're down across the board, but not everyone's down.
Not everybody's down. There are teams that are just out there kicking ass and taking names. But at the same time, market sentiment was, man, it's rough out there. There are some opportunities, there are pockets of opportunities for an institutional operation getting stood up. I mean, first of all, there had to have been concerns on your part, right? Like, we have to make sure we have these things in place before I'm confident that we're going to come out here and win, because everyone's watching, right?
Yeah, no, it came down to two things: strategy and capital. If I had the right capital and the right strategy, I really wanted to do it again. Without both of those things, it's not worth it.
And so let's go to the capital side. The capital side, one of the biggest complaints of last year was with rate volatility and capital being inconsistent. You saw folks, like you said, they made the right choices in their capital partners and they did quite well. Other folks struggled and other folks shuttered, right? And so with that in mind, can you give me more color on what you're talking about in this right capital for the right loan, right?
Yeah, you want to start one of these, you have to decide, how much control do I need versus what type of capital do I want? There are a bunch of different trade-offs that you have to decide. And there's also the other thing that's interesting, and I've spoken to a couple other people that have been, relaunching in the past 12 months. And I think there's a little coffee clutch that gets together once in a while. And I think one of the kind of common themes is that there are all kinds of people who want to invest in the operating entity. There are lots of people who want to invest in the assets at any given time. And there's another theory where you find an investor who wants to do both, which is actually kind of the hardest of the three different approaches. We also have the least flexibility. It depends on what your goals are and how you manage the. And there are definitely pluses and minuses of each of the three approaches. You don't have to. Anybody can sell assets, right?
I mean, ultimately, you can. I mean, if you really hustle hard enough, you can find a buyer for these loans. But whether you make money or not is the question, right?
Look, even if you're someone who does have a capital source that is interested in assets and the entity, which is not always the same person, right? Because the entity is not a fixed income instrument, right? Like it's actually understandable that people aren't necessarily interested in both. But even when you find that person or that that capital source, you may also have other things that you do. You may still be selling loans. Like I was always a fan in any of the companies that I've run, making sure that I was securitizing and doing whole loan sales. And maybe it's a different percentage of one versus the other based on how the market's doing. But you don't get 5 basis points smart and don't do whole loan sales because the securitization market is inside. You need your pipes open to the different types of capital at all times. And so you do have to manage how you deal with the outside world.
So for you, for the capital side, what were the goals when you're laying the foundation and getting ready to gear up? What were the goals in the right kind of partners for you? Because this is not going to be a small business. This is you're going national. So
yeah, I know. I've always been more I've always tended more towards having somebody who's both in the entity and who likes the assets. I have found that to be an easier partner for me. I have seen other people do incredibly well without doing that because they may have more control that way, or they may be dealing with somebody. Like I said, it's not always a fixed income investor is not always a natural private equity investor, and vice versa. But being able to at least have some combination of that has been very positive for me. It also just cuts down on it's great to have a partner who actually understands the space and is interested in the space, not just in other things. I mean, it just depends. I mean, there are real benefits to each of the different models, but for me, that's always worked the best.
Right. Okay, so I want to pivot to more of an entrepreneurial conversation. We kind of touched on it a second ago. You didn't have to come back. You could have rode off into the sunset.
I know. Okay, Kevin, I surprised myself. I kind of surprised myself. I knew I just wasn't done.
So expand on that, because from an entrepreneur standpoint, the audience is filled with entrepreneurs, and it's always we always miss out on that piece of the conversation. What was driving you?
Yeah, and I guess one of the things I also figured out. I mean, this may be I'm very transparent. Like, this may be too much transparency. But one of the things I figured out about myself was I actually am an entrepreneur. Who knew? In that this is what I drive my satisfaction from, is the build. I will tell you, one of the other things that was incredibly satisfying for me last year before Encore launched was a lot of the conversations I had with other people in the market and around institutionalization of capital and around how much impact different things have had on the space. And I realized how much pleasure and how much satisfaction I derive from having an impact on the space and on the items that we've been talking about. It felt better to me to want to come back and say, okay, look, I do have an idea on how to get the securitization market functioning for this particular asset class, and I want to do it. I don't want to just have the idea. I actually want to do it. And surprised myself actually a little bit in the risk I was willing to take from the beginning. But that is what you're supposed to do as an entrepreneur, is take some risk. And measured risk, you want to do it the right way, but it's where I'm deriving my satisfaction. And so it made sense to come back.
So the itch came calling again, and you're like, and then you saw a need, and lo and behold, here we are. I love it. That seems to be a common trend.
Yeah, and I just kept saying, look, I have to both feel the need and have the right partner. And I think getting both of those things right is what makes it satisfying.
Right. And a lot of our audience are kind of at that stage where they're having discussions. They had or are having discussions with partnering with either an institutional, quasi-institutional business where they're pursuing the same kind of structure you're talking about, right? They're an investor that understands the enterprise value of the operating company, but also likes the asset class and is interested in purchasing them. These conversations are happening a lot. For the less seasoned operator, right? The newer operator, the young entrepreneur who's in his 30s and 40s and really out there killing it, but just doesn't have the experience. You have any advice for them on what to think about and what to watch out for when it comes to having these conversations or even preparing for them? Because those term sheets can get kind of intimidating and also quite tempting.
Yeah, and look, you're going to wind up giving up a lot of control no matter what, and you have to be comfortable with that. And so what I normally tell people is, don't fight so hard for control, because it's asymmetric. They actually have the money, you don't. Okay, you're probably not going to get control. Like, no one is going to give you the money and say you have a 50% vote when they're putting up whatever capital that you don't have. But what you can get is alignment. And I believe alignment goes further sometimes than, some contractual minority voting right is going to go. Because if you're really getting to the docs, you actually don't have a partnership anyway. And so but if you focus on building a partnership where you have alignment, where it makes sense, if you're growing, they benefit and you benefit. Are you benefiting the same way? is if there's a promote structure in place, is your promote and their promote the same or different? Like, what you really need to focus on is not whether, you control something, but whether if you perform what you're doing and you hit your numbers and you produce the right type of assets, is there alignment between you and the capital source? And I think that's what's going to carry the day, because to think that you have symmetric negotiating ability, I mean, you may have great ability, but the fact that you think you're going to negotiate with somebody who's got a couple billion or trillion in assets and you're crazy. Right? And yet I've been successful at building partnerships where I feel like the alignment works for me, if that makes more sense than the term sheet.
No, that makes sense. It's one of those, it's a very challenging concept especially for the regional originators turned direct lenders whose volume has gotten to a certain place where they're not now in the position or privilege to have those conversations. The entrepreneur in them is saying, I'll never give up control. But in reality, what you're saying, and it makes sense, right? Because literally you have no leverage. You have to figure out what kind of alignment, and alignment meaning also runway to do what you do best. Because I think that's a lot of people overlook that. It's like they concentrate on the numbers too much and they don't realize, wait a minute. Am I going to be allowed to do what I am very, very good at?
And if you're not, maybe it's not the right deal. Right? Like it's not necessarily about how much are you taking into the company. Can the company grow or develop in the structure? Because you always have the option to not sell to somebody. No one is saying you have to do that deal. And if you're in the position where the deal's in front of you, probably you're being pretty successful at what you're doing. And so maybe the right answer is just continue what you're doing and bootstrap it a little more. Maybe you won't be as big, but you yourself will get more satisfaction and have more in the game.
Yeah, and we've had clients walk away from tables telling us that, like, listen, this is cool, but this will be probably really, really good for us, but it doesn't align with my values and what my goals are, and they decide to keep it private.
It may be good for my bank account for the next 6 months, but is it really good for me for over the next 5 years, 7 years?
Right. It's probably going to give me an ulcer. That's true. Yeah. Alignment is so important there. And then there's that trust issue as well. It sounds like you've been able to find partnerships that you've been able to build that level of trust with in that alignment concept. But ultimately, I mean, institutional or not, there still needs to be a level of business trust there.
I agree with that. And in fact, several times my capital source has wound up being somebody that I had a trading relationship with prior to, or some other type of business relationship where you know how the person behaves in a certain situation. Now, you'll never know exactly what it's like to be at the board table with them until you are, but having prior trading relationships or other types of, economic relationships really does help.
Right, and building that level of trust with them and that level of almost courtship right beforehand, before the marriage actually happens, seems to be an imperative feature. Like you can't just jump into something that you don't know from Adam. It doesn't make any sense.
You can't underestimate this notion that not everyone really understands the space that well. And even in this space, we all have kind of a slightly different bent. And if you're spending so much time educating them as to what you do, it's going to take a long time to get that investment across the finish line, and it may or may not work.
Right. If they're referring to this as a non-QM investment, you probably want to think twice. I want to pick your brain on where we're going on capital, because the market has had some strange phenomena as it pertains to capital sourcing. I did not expect Lifeco to be jumping in this hard into the space.
Isn't it amazing? That is the word of the day, right? For capital is definitely Lifeco. That is where most of the attractive assets are.
We saw always like smatterings of it, but the fact that they're picking up the vast majority of the volume right now is fascinating to me. But the question becomes, everyone is kind of waiting for the other shoe to drop. Like where are we headed? Where and we're having conversations about securitization, ratings, and and new institutions coming in and buying spreads coming. What do you where are you seeing things? What do you think is coming? Because our audience is kind of waiting to figure it out, right? And they'll jump on it when it comes.
I literally had a meeting today with someone on the who's deep in the securitization market, has a couple deals coming out next week, had one close, already this month. Securitization, particularly in RTL, is coming back. It's back. I mean, it is back. It's executing fairly well. It's not executing at the tights, but it is accretive to what people are doing in the business. And it's getting even probably better. And the good news is, I think the vibe session may be over, in that people's sentiment is actually coming in line much more positive than it has been. And so even if you think about this past December, this is the December before. The December before, there was nothing happening. Transactions came to a grinding halt because people were so unsure of where rates were going, what was going to happen. The sentiment was just played, I'm going to wait and see. I'm going to finish out the year. I'm done. I am not touching a thing. This December, there was some green shoots and there was a little bit going on, not a ton, but all of a sudden, the sentiment has moved, which is causing transactions to happen. Once you start having more transactions, which I'm seeing people kind of getting to the right numbers, then you're going to see more capital come back in. I think it's amazing and great that the life cos have been as strong as they have been this year. They certainly have a real appetite for the type of asset we're producing, because it matches their balance sheet so well. But it's not every bucket, like we mentioned earlier. And so we need other transactions to start happening for other types of capital to still come back in. I mean, if you recall a few years ago, the notion on build to rent was that, first the headlines were $30 billion of equity raised for build to rent. And then it was $50 billion of equity raised for build to rent. If you leverage that, you couldn't build that many houses, right? And so then all of a sudden things weren't happening, but now you're really starting to see again that the transactions are happening. The people who had capital during this period of time continued to build. And now you're seeing lease up activity and these communities starting to really happen. And I think that's generating more activity. We're even starting to see scattered site again.
Which explains the volume that we saw recently at this commercial event. I had not expect to see this much built to rent volume. And it seems the capital is back asking for it. But the question that I always ask is, we haven't had any meaningful change in the rates just yet. And it feels like people are still kind of it's just sentiment. It's just kind of it feels like we're headed in the right direction.
Yes, I believe it's sentiment driven. And I've always felt, and I think I've said in past panels, that it's not so much the absolute rate. It's not that different on a spread plus base rate than it was even when we started 10 years ago in some of these loans. The combination is not that different. But the sentiment was such that everyone was on the sidelines.
So basically, the bonds wouldn't sell. They wouldn't get. It's not a pricing issue that no one was interested in buying because
people were done.
Yeah,
they were waiting because the problem is that if they bought at what looked like an attractive yield based on their models, 3 weeks would go by and they'd be wrong. It was too volatile, too fast, right? You can't be that wrong that fast and continue to buy bonds.
Right, and being wrong that fast makes the people that are on the trading desk look really bad, and then their jobs are at risk. Yeah. I get it.
They needed to stabilize so that they can actually put a trade on.
Right. Now, here's another thing: is that one thing that we got our ears on middle of last year, and we started getting intel from our friends at doing the securitizations, talking about this rating possibility. And listen, I work with lenders of all shapes and sizes, and it's still on everyone's lips. They're asking about these rated securitizations, and they have this bug in their brain that this is going to be this huge boon for the industry. Some critics have said that's actually a bad thing for the industry because it might overflow the market with too much capital. To me, you're one of the pioneers of securitization in our sector. You were one of the very first few. This is not something that's well understood. Can you educate and also a lot of people don't want to talk about it for some reason. Can you educate our audience on what's going on here?
Yeah, a rated deal will happen. I think it will happen this quarter. I think it's a positive thing because, again, more outlets are better than fewer outlets. But it's not a panacea. The first couple deals of anything don't price at the tight. Like the bondholders are taking the first mover and they're going to be paid for it. So people shouldn't be disappointed if it's not, it'll be inside of the unrated deals, but does it have to be significantly inside of it for it to be a success? No. Getting done is a success here.
Which explains why some of the institutional guys who are doing a lot of these securitizations are saying we don't want to be the first one to the door because they don't expect the pricing to be that accretive to them.
It's expensive. Like, I applaud the people that are doing it first because they are taking expense risk, and then other people will just copy. There's no intellectual property in the securitization once it's done. The first time it takes a boatload of effort.
But the question remains on the operator side because it's just the parameters are so thorough that when I was reading the guidelines, I was wondering, like, I don't know many lenders that can actually fulfill all of these evaluation parameters underneath the guidelines for ratings. These are very, very, these feel like something I would see in conventional or in a CLO.
The original box is going to be tight, which is also understandable for a new asset class. It will loosen over time.
But the quality of the operator seems to be a much more in question as well. Like the financial health of the issuer, financial health of the originators too seems to be a significant conversation starter, and that never used to be something we talked about.
I think they're probably looking at the buyback risk on the reps and warranties. If the operator's not there, obviously it doesn't make the reps and warranties worth anything. And so if you're rating it, that I'm sure that's where that's coming from. But again, they always start out strict and loosen as the market begins to understand and the bonds have some history. Remember, there's no history on it yet. Now, we have history because we generally know what's in the unrated deals and how they've been doing, but the overall market can't see those.
So they'll happen. They'll be the first of the door. So there's going to be pain with it no matter what. And it'll shape future conversations.
It'll be inside. It might also actually improve the execution on the unrated deals.
That's good to hear.
Some people can't own it without a rating. And so it will definitely increase the investor base for this asset class.
I wanted to ask you about that. So I was speaking with a client who, in a former life, was a bond trader, and he was a critic of this. He was saying, I don't know if I love this idea because right now the folks that can buy the unrated stuff is this. And then once you get a rating, the folks that can buy this is infinitely more because now you're opening it up to a larger swath of eligibility. Granted, let's just say, the first year of this is going to be remarkably tight and challenging to price under what's current market, right? I think you're right. It's going to price similar or within what we're used to. But in the future, as more of these get done, doesn't it raise the possibility of too much capital, oversupply of capital, flooding the space because of the eligibility now of all the different fixed income buyers that can come in?
First of all, I'm not sure you can have too much capital. And I don't think you can originate enough in the space to flood the capital and the bonds, right? Like there is some limit to what you can originate and how many bonds you can have. Truthfully, I think there's not enough issuers in the space right now to actually have the type of liquidity that the bonds should enjoy. I think you're still seeing a niche asset class friction on some of the trading in these bonds, just because there's not quite enough. Like, if you really want to be in a position where you're a serial issuer, so that and it's irrespective of market. People who are right now, they're still small enough that sometimes people are just trying to time the market, or they jump in when they think it's a little bit okay, and then all of a sudden there's 3 or 4 clustered. Like, it much better strategy to be, quarterly issuing. The bondholders know you're coming. They know that they're going to be tight on this one, but they're going to come in because they know that you're going to have bonds when it's a little wider. And over time, that's actually more positive for liquidity and for the market and for your brand as a bond issuer.
That's good to hear. I mean, I was thinking about like, are we going to start seeing some kind of funny trades happen or deals happen where all of a sudden we're seeing a market where, and he made the analogy where, do you remember when institutions first came? There were it was a time where you could, and his words are not mine. You could sell dog shit to the buyers and they buy it, right? And like, and he was like, "Do you want that to happen?" I'm like, "I don't know. I don't think that's possible. We don't have that many houses." But that's what I mean. I had asked that to the new CEO over at Anchor, and that was her sentiment as well. But
Look, I think if you're trying to just push junk into the market and off your balance sheet, maybe you'll have a great execution on one bond, but it's not going to build your brand and have a real, I mean, you're supposed to hold the bottom of these. These are commercial rated. Like, you're the first loss piece. You should be originating and structuring with the notion that you're there the day those loans pay off. And it shouldn't be like, when I think about securitization, it shouldn't be just an offload of risk, like it can be, particularly in the conventional space. What I think you should think of it as is a very attractive financing vehicle. It's a warehouse line that doesn't revolve once a year, and it's fixed rate. You can match duration, and you can match fixed versus floating. And so that is the difference between other types of back leverage. Now, you can get a better advance rate. Sometimes you can do other things, but really what you're trying to do is come up with a financing that matches your duration and matches your interest exposure. And that's your focus. You're not going to be, selling dog shit to anyone. You're going to be thinking about it because it's still on balance sheet to you.
that's a good point. The other part of the kind of weird part of this conversation was that there were issuers that are quite well known that have said, we have no interest in doing this. And it could be for the reason you just said, right? The first few of these are just not, there's no reason why we would do these,
Yeah, look, I was involved in the early NPL securitizations. And in fact, the first one that got rated when the market was coming back. There are no more NPLs to put in the NPL securitizations, but in the beginning, they were all rated. And the first deal took us like 8 months to get through the rating agencies. And because of the organic nature of the NPLs, half of them were gone by the time we got the rating, and we were putting new ones in, and then we had to go back and get another rating. I mean, it was like this, almost into infinity. You could keep going to the rating agencies with the extra assets that had to go in. And because it took 8 months to get there, and the pool was organic and evolving, it was also quite expensive, and the assets weren't necessarily there. But it was good, and we started doing several of these securitizations, and the market generally did it. Eventually, it actually went the other way, where people started doing unrated First of all, it started moving faster, so you got through the agencies faster. But also, people just started doing unrated deals because the market was used to them then. There was all of a sudden a benchmark and everything else. And they're like, wow, this is much faster to execution.
And that's benchmark is the key word there, I think. Like there literally is no benchmark. And so that's why it's going to be so hard for a while. Okay. So it's not some massive...
Our space is also organic. It's not as bad as NPLs in terms of resolutions, but bridge loans pay off. I mean, that's kind of the good news, is bridge loans pay off. Right?
Well, yeah, you want your loans to be paid off. You want borrowers to get out of the deal quickly. I want also, I mean, we talk about capital and securitization, but also another thing that I'd like to ask you about is your perspective on where we're headed as a market. The private lending market's in a weird place right now. We have never, like my particular department on representing smaller lenders has never been busier than ever. We've been converting more originators to direct lenders, more licensing work than ever, more small debt fund formation than ever. There's been a lot of like, all right, I'm going purely private. I used to just sell to the capital markets. At the same time, I interview CEOs at institutional business, private lending outfits. They're all saying there are significant tailwinds behind them, whether they're being overly bullish. I want to get your take because you seem like you're very level-headed on this issue. You don't have this like overly bullish perspective. But I want to hear the details because you're seeing all of it on the street. So.
One of the trends I think is very positive, particularly among the smaller mid-sized lenders, is the formation of the debt funds. I think controlling the destiny of where the assets wind up is very positive to the originations in those groups. Where people got left holding the bag was when they thought they had a certain offtake that just didn't materialize when you had all these fluctuations in the market.
So if you were an institutional buyer, you'd prefer your counterparty to have his own balance sheet.
I'm not sure, if you're an institutional buyer, you kind of prefer they don't have it so that you can hold them over a barrel when they want to change the pricing. I think having the debt fund as the originator gives you just more flexibility to do the type of loans that really make sense and to service your clients in a great way. So I think that's actually I think it came out of people holding the bag on loans that they couldn't sell or that they thought were sold and didn't sell and stuff. But I think it's a net positive to the industry and puts the industry on stronger footing when people have these debt funds. So that to me is a very positive outcome of kind of the dislocation.
But the dislocation seems to be at the originator level. I mean, the institutional shops have been busier than ever, they're saying.
Yeah, there's a few things going on. There's a kind of mini refi boom for stuff that was done, earlier. Not that, the 21 vintage is going to be tough, but the earlier vintages really are ripe for refi right now. And they need to do something. And they've had great HPA. The assets are like in the rental business, the assets have been rented. Even on stuff that was like early DSCR loans, they're through the prepay period. And, some of them were at really high rates. And it's not just about rate, right? The assets have appreciated so much in value and the rents have improved that they probably have decent coverage. They may be able to come in at or below with some cash out.
That makes sense. We had a conversation with a client in Florida that said that they believe that DSCR is going to pick up significantly because of what you said, and then the resurgence of, what do you call it? I call it a consolidation loan, but I think it's a portfolio loan. These were really popular for a long time. They went away for a while with all the volatility, and they seem to be coming back in a big way. And let me ask you this: will Encore be participating in all that?
Absolutely. I mean, we love the portfolio loans and are seeing, it's actually exceeding my expectation, the number that we're seeing. I was expecting to see some, but I wasn't expecting to see as many this early. And I think it has to do with the sentiment changing.
And borrowers have that HPA, they have that stabilization, and they also want a better rate.
Yeah, they own the assets or they're building the assets. There is actually scattered site build to rent too, where people are building like urban infill, or people are building enough and then putting it together in a portfolio. There's a bunch of different strategies, none of which are huge, but together it's a lot.
Right. I mean, this industry is built on base hits, so that makes a lot of sense. Or you're just aggregating base hits across the country.
The rental rates, particularly in SFR, are still incredibly strong. You're not seeing the downtick that you're seeing in some of the multifamily markets.
So that's the thing, right? And so we're seeing a lot of people shifting away from shifting away from conventional residential and jumping into the sector because of that opportunity, and they have the deal flow. But in my brain, I was always wonder, like, there's the finite universe of inventory and the difficulty it is to build. I mean, you really have to be. I mean, there are pockets of the country where it's easy to build, but the vast majority, it's challenging to build. Equity capital is hard to come by right now. And then lastly, there's just no inventory. There's so little inventory. It's so tight. I mean, as someone who's looking to buy a second home, I'm literally in bidding wars every week, and it is frustrating how little inventory there is. And so, like, from a macro level, our industry seems to be very busy, but I think it's because it's so niche. Do we face a crisis of our own because purely there's not enough builders, not enough new homes being built? It's a question I always wanted to ask.
There are not enough new homes being built. I mean, it's one of the reasons people love build to rent. But remember that there is also always a baseline of housing stock obsolescence, right? Like, housing does get old, and I'm sure that you will find your attractive second home, but it's probably not workforce housing that you're looking for, Kevin. I'm guessing. I'm just guessing it's not workforce housing. It might be, but I'm assuming it's not. And there are definitely pockets of the country where the workforce housing could use a facelift.
Oh, yeah, that's very true. And that's actually what's been nice to see is workforce housing is making a big comeback. A lot of inventory is being injected into the market in that kind of sub $500,000 transaction type home, at least on the West Coast. Midwest, probably sub $200,000 priced home is being pushed back into the market.
I'm a huge fan of workforce housing. I have always financed workforce housing. I probably go a little lower than the average lender rather than the mansion flip. I'd actually rather see a portfolio of stuff in the Midwest that's, particularly high yielding for what it is, but where you can actually still do an acquisition of assets because it's depleted. You can actually put something back into the housing stock that's livable versus new construction from ground up.
But on the counter to that, though, like the industry's been hot and heavy now. I would say let's be a little bit liberal with it. 20 years, right? 20 years is a long time. The fact that is there still enough aging inventory that needs to be obsolescent inventory that can be pumped back into the market?
Yeah, in the Northeast and in the some of the Midwest cities, absolutely. There are still whole neighborhoods that can be revitalized.
With the silver tsunami and all that, it does make sense. You have a lot of aging, a lot of folks moving out of their homes or downsizing or moving to Florida or whatever it is. It's always been one of the most counterintuitive points to think about because we've been fix and flip and construction has been around for a very long time, but yet we're always complaining about inventory. So that's always been.
Yeah, no, there was only that one period of time where the inventory was huge, which was really driven by the mortgage crisis. But the notion that older homes need to be revitalized and go back into the housing stock has always been a concept and will continue to be a concept because there's always some cohort of homes that's aging out.
I want to ask about a different asset class, is multi. So multi's been a weird one.
Isn't it though? Yeah.
It's tricky. How does it pencil in our sector?
It's complicated right now. Yeah, I was just having this conversation with someone today too about multi at the the really small multi. So something that's, 5 or 6 units and, million, whatever. There's financing for that. Even most of the DSCR lenders will do that as a DSCR loan. It's liquid. It securitizes well with the multiplexes that are technically SFR. And if you've got a $250 million multi that needs whatever, the debt funds are all over it, the institutional capital. The issue right now in multi is the teenagers, right? They're having a really tough time. And it's because I think there again, it's because no one knows what the cap rate is. Don't actually have sentiment that is solid around the cap rate and what it is. And people are just afraid they're going to pick a cap rate and 3 weeks from now it's going to be lower again. And you are starting to see some rent pressure and stuff on the what I call the teenagers.
Yeah. And one of the things that I was talking to, I think it was, I forget who it was, the new CEO of Fidelity Bancorp out of LA. He's from Wells, and we're talking about small balance commercial in general, especially multi. And I was telling him, like, if you can get the capital to buy these loans, you will do well because this used to be a thing that in our industry the buyers would buy. Small multi was a conversation to be had, and then it just died. No one touches it anymore.
Yeah, it was the expansion loan for a lot of the normal private lender market. Like multi was the ticket to the next level, right? Right. Well, and I think it has to do again with the sentiment because there's been too much movement too quickly and nobody knows where it's landing.
And you don't want to price it wrong and be wrong the next day or the next week.
Can't be wrong 3 weeks from now on a consistent basis.
All right. And if you're holding that loan on balance sheet, that's tricky, especially when everything else is pricing up. Yeah. Okay.
And the other ones have such strong fundamentals.
Yeah, and resi's always been very good to do, and there's not been any volatility comparatively speaking. So why not just double down on resi? I understand it now. Okay, thank you.
Unless you can't find the volume.
Yeah, yes.
You could add to your earlier point, Kevin, that if the volume's not there, then maybe that's why they're doing multi.
Right. I want to close out with kind of what you're looking forward to. It's still early 2024. We've got a big year ahead of us, according to all the experts. What are you excited about going 2024? What is Encore going to be pushing out, and when are we going to have our Encore's big coming out party at the industry events?
Yeah, I do want to have a big party. I definitely want to have a party. I have to pick where. Look, I am really looking forward to this year. It's hard. I kind of pride myself on having like clean numbers and hitting my numbers every year, and I have not quite enough operating history to be as confident as I usually am. But I'm confident in the year, and really look forward to seeing kind of increasing volumes and new people in the space. And I'm looking forward to getting some type of securitization done, whether it's small and directed or rated, or seeing that market come back, I think is very validating. And then just plain, being part of the industry as it sees this uptick. I mean, I saw a line today somewhere, people have been saying that whole, like, stay alive till 25.
Said it.
And someone else said, yeah. Someone else was like, stop saying that. Let's do more in 24. And I actually think we have the possibility to do that.
It's logical, right? The volumes went down so much in early 23 that we have to be doing more in 24. But the sentiment was made, actually. So Nima and I did a panel at Apple at AAPL. Literally,
by the way, my year-over-year growth is going to look really good.
We love it, right? We were saying that the title for the panel was "Survive Till 25" because someone at Deloitte had said that to Nima at a cocktail hour, and he was like, "Yeah, it seems like that. I mean, it seems like our clients are really just trying to live to fight another day." But also, but you've got the excitement of a new business, and I think that also fuels the fire a lot, and that's going to allow you to swim that beach.
Yeah, it is so fun to be in a growing business.
Yeah, it is.
And like I said, it's actually easy to be year-over-year growth when you didn't have any last year, but that's okay. I'm taking it. Like, I like the feeling of the year-over-year growth.
Right. I love it. Well, I'm excited for you, Beth, and we're really excited to see you guys come out there and storm that beach. Hopefully, we see you guys throw a big party. It could be coming out party at one of our industry events.
I would love to.
Yeah, I'll make sure we talk about that. But I want to say congratulations on the new enterprise, and for all of our listeners, please keep a lookout for Encore Finance Capital. And this is Kevin Kim signing off for Lender Lounge Season 4. This is our closing episode for the season. Thank you very much, Beth, for joining us.
Thank you. It was a pleasure. Absolute pleasure.
All right, guys. Well, that's all I have for today. Thank you so much for all of your time, and we'll see you on the next one. This is Kevin Kim signing off. You've been listening to Lender Lounge with Kevin Kim, brought to you by Gerasi LLP, the nation's largest private lending law firm. Gerasi is the leading legal resource for specialty lenders, asset-based lenders, private lenders, and non-bank institutions. Learn more about the firm at gerasilawfirm.com. That's GERACI lawfirm.com. Check out our episode summary to subscribe to our Lender Lounge newsletter and our law firm newsletter, where you can get notified about new episodes and recent content directly from our expert attorneys. In addition, we'd love if you follow Lender Lounge with Kevin Kim on YouTube, your favorite podcast platform, and on LinkedIn, where you can also check out updates from Gerasi LLP. Thanks for listening, and we'll see you next time on Lender Lounge with Kevin Kim. This is Kevin Kim, signing off.